wherever you're listening to this. This is the Up on Cyber podcast presented by Ariento. Today, we're fortunate to be joined by Nick Pottebaum, who is the Vice President of Reinsurance and Programs at Tokio Marine in their Cyber and Professional Lines Group. Tokio Marine Insurance or Holdings is a multinational insurance company headquartered in Tokyo, Japan. It is the largest property casualty insurance group in Japan in terms of revenue, and is the parent company for Tokio Marine Group, which employs 39,000 plus folks worldwide. Nick, welcome, and thanks for being with us. I know you're out in Chicago. How's the weather out there?
Thanks, Chris. It's good to be here. And the snow's melting in Chicago. It was a pretty snowy winter. We had about 3 feet of snow in a 3-week period that ended maybe a week ago, and now it's warming up and it feels great. So it's not Southern California where you are.
Yeah. Although we have a rainy day today, so I'll join you in commiserating the weather. Anyway, if you're up for it, we'll kind of jump right in. I know cyber liability has been a hot industry and hot topic for a while, and only seems to be getting more and more attention. Can we just start try and break down the basics for folks that are coming in and don't know the industry? What types of cyber coverage are there? We hear a lot about first party, third party. Can you just kind of walk us through what's out there in the market and what people need to know?
Totally. In general, in probably, broadly speaking, with insurance, there are first-party coverages and third-party coverages, and what that is alluding to is the first party. That's you. That's the insured. The second party is the insurance company, the carrier, and the third party is everybody else. So in broad terms, if you have a first-party coverage, that is the insurance company is covering you as the insured from a loss. If you have a third-party coverage, the insurance company is protecting you as the insured from a lawsuit or a loss stemming from another individual. So, as that would pertain to cyber and cyber insurance, first-party losses are attributable to the breach. So whether that's cyber crime, cyber extortion, breach event costs, post-breach remediation costs that an insured is dealing with, those would be first-party losses. Now, a third-party loss, that would, if you as the insured is sued by another individual, then security privacy liability comes up a fair amount. So if you released another individual's data, accidentally, or were breached and you lost their data, that could be a potential third-party claim. There are certain defense penalties. There's the payment card industry that you could be potentially sued for accidentally losing or misplacing data. And then the other one that gets talked about a fair amount is multimedia liability, and that can come up in a number of different ways. But one that I've seen a fair amount has been, not related to a breach, but you would have an entity using trademarked data inappropriately, or showing you have a restaurant or bar that has a special, and they're promoting their special online, and they pull an image of a famous person. That famous person has an attorney that comes and sues them for using their image. That comes up a decent amount as well.
Got it. Okay, and so is it fair to say that, because I think one of the questions that I hear a lot is, what am I covered for? Am I covered for anything in my general liability when it comes to cyber? Is it fair to say the answer to that is no, and you require some sort of specialized policy?
Totally. Yeah, and that's, over the years, you maybe heard the term silent cyber exposure, and in the policy language has been tightened up quite a bit, in the last several years, and we maybe dive into that later. But the idea of silent cyber, or where you have a general liability policy or property policy that doesn't explicitly cover or exclude cyber events, that's called the silent cyber exposure, and that's where carriers can potentially get in trouble if there's not an exclusion on their GL policy or property policy, and then in affirmative coverage, either via endorsement or separate cyber policy.
Got it. And you mentioned kind of the endorsement to a policy or the separate policy. Can you just kind of talk about the difference and specifically, which is geared more towards what types of customers? So as a small business, what should I be looking at? Is it more based on my carrier, or is it just kind of personal choice?
Yeah, sure. I think in general terms, the smaller, if you're buying a BOP policy, a business owner's policy, and you're a small business, your carrier may have a embedded cyber endorsement solution for you. Either it may be included on everything, on all of the carrier's BOP policies, or it may be an optional endorsement add-on that the business owner can select. But typically smaller businesses may be more likely to be covered under an endorsement to their BOP policy. Larger companies would typically have a standalone cyber policy. And a lot of that comes down to the broadness of cover that's needed, as well as the limits that they need to purchase. So most larger companies are buying fairly high cyber limits, and they probably want the broadest cyber protection available. Whereas the smaller companies who are including cyber as an endorsement to their BOP policy, their BOP policy is most likely a filed policy. So it's admitted paper. Admitted means that you file the policy language and rates and rules with a state department of insurance. Non-admitted means that you don't have to. So if you have a BOP carrier that is filing the rates and rules and policy language, it's potentially harder to make changes to that policy. It would require refiling, et cetera. And so those policy endorsements are oftentimes a little bit narrower and lower limits, lower insured limits than a standalone policy that you'd go out and buy specific to cyber.
Interesting. I'm taking notes myself. I'm learning a lot. You kind of reference potentially like pricing, and I remember when cyber liability started to get hot, and there's kind of a famous quote out there that Warren Buffett said years ago that I don't think we or anybody else really knows what they're doing when writing cyber insurance. We don't want to be a pioneer on this, and I think what he was referencing in that quote is kind of the risk exposure and the pricing, and there wasn't a lot of data back when this started. I personally, in our business, I've seen these applications change and get a lot more detailed over time. Can you just kind of talk to us about that pricing evolution, and then as to where we are today? I guess how do you feel about the pricing of it? What rating variables matter most when getting cyber liability insurance?
Totally. Well, and you're quoting Warren Buffett, and there's a lot of good quotes to choose from. And I'm thinking of one that he said, "I'm going to screw it up," and you're recording. But he mentioned be greedy when others are skeptical when others are greedy. Yeah. I don't know that one applies here. With cyber, it is an evolving market. It's an evolving space, and pricing practices are changing rapidly. Still, I would say that the rating factors, the exposure base for cyber liability is still typically, revenue for most companies, sales for most companies. So the larger the company is, the higher their potential cyber exposure. Number of records, the higher their cyber exposure. That changes based on industry to a certain extent. If you're talking about a municipality, for instance, they have their tax revenue, but that would be, for a municipality, you might use something like total operating expenditures. You'd look at their budget to try to get an idea for, the type of general exposure they have. You might look at the population of the state or town. And then, aside from that kind of core exposure driver, you'll want to look at the segment of business. I just mentioned municipalities. They've been hit pretty hard, particularly with ransomware over the last couple of years. So you'll want to look at the class of business, but then even outside of that, there's a lot of, variability from company to company in the level of, cyber hygiene and internal controls that they have. And that's becoming a greater focus of, the rating exercise, as well as just the general acceptability of the risk. And so things there, having secure backup locations for your data, utilizing and requiring, two-factor or multi-factor authentication, secure remote desktop connections, and these things will not only help prevent losses, but they'll also mitigate the damages. You think about two-factor authentication might help you prevent a data breach, a ransomware event. And then you think about the secure backup location. If you have a data breach or a ransomware event, you may not need to pay that ransom if you have all of your data backed up in another location. You may make the decision that it is better to retrieve your data from the secure backup and tell the hacker to pound sand and not pay the ransom. And so those are considerations now more than ever into the pricing of cyber insurance, as well as the partnership with risk mitigation firms, people like yourself, and looking at ways that as an industry we can not only be capacity providers, but we can also help make the digital world a safer place and help mitigate the actual loss event.
Got it. So this is me trying to dumb it down, and I come from, when I started my career, I was in auto insurance, which is a lot simpler than cyber liability. But is it fair to say, kind of, when I heard you talking, I thought you mentioned revenue, number of records, industry, things like that. That was kind of the exposure, the environmental variables that maybe a company can't really control. I mean, I guess you could drop your revenue, but why would you want to do that? Whereas the latter ones you're talking about, cyber hygiene, is the stuff that they can control. Having the right technology, having it in place, processes, procedures, partnering with firms, whatever it might be. And so is that assessment kind of correct, of the breakdowns? And then if assuming it is, it sounds like the pricing is getting more and more granular on the second front, the stuff they can control.
Totally.
Is that
absolutely? No, that's a great assessment, and it's spot on.
Okay, cool. All right, and then what about I got to ask the COVID question. How has that? I know the insurance industry, different lines of insurance have been hit hard with COVID, but some not really touched. I mean, I just mentioned auto insurance; they're giving credits back, right? How has that affected cyber liability and both now and then kind of like the future outlook?
Well, yeah, you can't have an insurance discussion without talking about COVID right now, and it is variable across the industry. And I'm thinking about, there are certain segments of the market, travel insurance, event cancellation insurance, that are decimated, that have suffered just tremendous losses, attributable to COVID. When you have a long period of time when people are not meeting face to face, and there are, if you're a event cancellation insurance writer, you're probably in a little bit of trouble because of that. I think about EPLI came up quite a bit in the, a lot of discussions at the front end of the pandemic. kind of earlier months in 2020, where there would be disputes between
what is EPLI, just real quick?
Oh, sure. It's employment practices liability insurance. And so if you're a writer of that, you might be concerned, certain claims come up where you have an employer that is, requiring people to, come back to work when they really shouldn't be, and the employee, disputes that, and and they get fired for it, or certain scenarios like that will trigger these employment practice issues, and potentially a lawsuit and a claim. You mentioned auto rate reductions, fewer miles traveled, fewer cars on the road in the work from home environment. Traditional general liability, the old slip, trip and fall accidents that are really the frequency driver of a GL policy. You have fewer people out and about, you probably have fewer slip and fall claims. And then you get to cyber, where it's a little more nuanced. Working from home has changed the landscape. It's changed the landscape tremendously, and there are potentially less secure devices being used. People working from home devices that aren't provided by their employer could potentially increase the opportunity for cyber attacks. We're seeing phishing emails that are targeting user credentials. One thing that we're seeing more on the kind of individual personal cyber side, we do a fair amount of personal cyber embedded deals where the insurance is the cyber insurance is attaching to homeowners policies. In that scenario, we've seen instances where hackers are targeting unemployment benefits. Hackers are potentially targeting COVID relief checks. And so some of these kind of identity theft related scenarios are ticking up a little bit with the pandemic too.
Yeah, I think I heard something the other day. I'm trying to remember who said it, but an engineer saying, "I've never seen the cyber environment this active." This was a defensive person, but yeah, interesting. So overall, though, that cyber liability affected, but not like some of these others, either positively or negatively. Is that?
I think there's been an uptick. There's definitely been an uptick in claim activity, and throughout 2020, there's been a huge uptick in claim frequency. How much of that is attributable to COVID versus other factors? A lot of it's related to ransomware. It's hard to say exactly, but I would say that COVID has had is correlated to the claim activity we've seen.
Got it. You kind of going back, you mentioned policy language in one of your first answers, and just kind of professional or the endorsement policies being more narrow language. They're having to be filed with the state, not very flexible, and then kind of the sole policies, not maybe as much, or sorry, you said admitted versus not admitted. What are some typical exclusions from coverage that, when it comes to cyber liability, that people need to be aware of and look for in their policies?
Yeah, we talk a little bit about silent cyber, and for a long time, it was unclear whether cyber events were covered in a non-cyber specific policy, a general liability policy, or a property policy, and that has tightened up over time. The one area that there was a ISO came out with the cyber incident exclusion in the fall of last year. That is an exclusion from the ISO property policy. ISO, by the way, is the Insurance Services Office, but they develop policy language for a number of insureds. And so a lot of kind of standard, especially when you get into, some of the smaller mutual companies, and even really the larger insurance companies, a lot of that standard base form language is derived from ISO. And so ISO came out with this cyber incident exclusion in the fall of 2020 that basically said cyber events are not covered by your property policy. There were a few carve outs. So if it was, if the event was, resulted in a fire or an explosion, that would still be covered. The fire, the damage from the fire, the explosion is still covered. But one thing that would not be covered would be, business interruption, spoilage of, and so if you had, an example that we've kind of thought about would be a scenario where you are a food manufacturer and you have, your assembly line is shut down, the machinery is shut down because of a data breach, cyber breach. Mm-hmm. And you lose all of your inventory, the food inventory, due to spoilage. Based on my understanding of the cyber incident exclusion language from ISO, that would no longer be covered on the property policy. Now you ask about exclusions, what's in the cyber policy, what's not in the cyber policy. Most cyber liability policies don't actually cover property damage, bodily injury or property damage, BI or PD. Or if they do, it's at a a pretty material sublimit. I mean, you think about these companies may have several $1 million of property coverage, and this type of event may have generally been included within their property limits prior to the cyber incident exclusion language, and now they either don't have it or it's at a pretty substantial decrease in limits in many cases. And so that would be maybe an area that if you are a business that that would be highly impacted by that, it would be prudent to to consider the impact to your own operations because of that exclusion.
That's interesting. Yeah, it just goes to show you how quickly this stuff is changing, and at least I'll speak for ourselves. We rely a lot on our insurance agent to let us know, and we'll have to ask a few more questions next year. Anyway, so you started to well, I guess it wasn't exactly supply chain, but you talked about manufacturing and with Huawei and some of the stuff in the news in terms of supply chain, and then SolarWinds, of course, which just happened and is kind of massive and seems to be changing the industry in terms of a supply chain attack. And you look at the DoD's doing the cybersecurity maturity model certification, CMMC, looks like that's going out to the whole federal government. Supply chain seems to be kind of the big topic. What does that mean for the cyber liability market? If you're a second, third, fourth, fifth down the line, and you get caught up in one of these supply chain breaches, number one, and then number two, a lot of those it seems like, are nation state actors, which my understanding, at least in our cyber policy, is excluded a lot of the time. So what happens then? How is it determined a nation state actor and whatnot?
Yeah, the supply chain attacks are scary from a cyber risk standpoint because of the the potential loss aggregation in a in a typical cyber data breach scenario. You have a bad actor that is able to exfiltrate data from a single entity. In a supply chain attack like SolarWinds, the hack is on the service provider or the software company or whoever else it is, and the malicious code is then spread to, in SolarWinds, I think it was 18,000 separate companies. And in the case of SolarWinds, SolarWinds, it appears, was breached in September of 2019. The malicious code was injected in February of 2020 to their Orion software.
Mm-hmm.
That software was then rolled out between March and June of 2020 to these 18,000 estimated companies, and it wasn't identified until December by FireEye. And so you have a scenario there where the SolarWinds breach was in late 2019. The bad code, the malicious, the virus essentially was embedded in February of 2020, rolled out in second quarter of 2020, not identified until the end of 2020. So that's a pretty long period of time. And the hackers in the case of SolarWinds were very disciplined, and and in order to be undetected for so long. Now with that, so 18,000 companies now have a breach potentially. But from there, there's it doesn't necessarily mean that all 18,000 companies lost all of their data, and from after the initial breach, the hackers used more strategic hands-on keyboard attack, premises and cloud to steal credentials and move laterally within the breached systems and networks. And that's really where the damage was done. And so I was reading a report from our company that was sent out that estimated potentially around 100 entities in the private sector and maybe 9 government agencies affected. But still, that's it's I think BitSight estimated $90 million in insurable loss related to incident response, forensic services costs, post-breach remediation costs. Interesting thing with SolarWinds though is the motivation for the attack was information stealing. It was espionage.
Mm-hmm.
It's not hard to foresee a scenario where that same malicious software would be used to trigger a ransomware message that all of a sudden pop up on the infected devices that say you have to pay 2 Bitcoin to XYZ. As far as insurance coverage, that the data remediation should in most cases be covered, but I would think that I'd urge people to look at the individual policy language. There's the war exclusions and things like that. Oftentimes the language on that is there are certain carve outs for cyber terrorism and things like that. But that's something that would be specific to the policy. Other thing to maybe mention though, real fast on that is there's an DoD there's an OFAC restricted entity list that prevents the payment of ransomware to individuals or entities on this restricted list as a matter really of national security. And so to the extent that you are asked to pay a ransom to someone on this OFAC restricted entity list, you can't do it without probably some sanctions coming your way. Mm-hmm. And an insurance company will probably not repay that ransom amount because they're restricted by OFAC.
Yeah. I mean, it just seems to me like this is an interesting I won't call it a gap in the market, but I get it from the carrier side, from you guys, in terms of insuring against nation state actors who are putting resources into this that are well beyond a private company. And I get it from the company standpoint that gets caught up in one of these breaches, but it's attributed to a nation state actor, and it seems like at some point something's going to have to, probably the government, I guess, step in to figure out how to, as this stuff grows, the nation state actor stuff grows, how to help those companies when.
Well, yeah, totally. And look, I mean, especially as it pertains to ransomware, it's a big discussion. It's an ongoing discussion on, do you pay the ransom or do you not pay the ransom? And it's tricky. A lot of people have just a guttural, they will not pay, don't negotiate with, people who've stolen their data, don't pay the ransom, we'll find another way. I think, it was the city of Atlanta, right, where you had a ransom request for $50,000 or something like that, and they've incurred millions of dollars, restoring their systems. And so there are some companies, there are some entities that look at that and they say, look, we need to be back online. We're going to pay the $50,000 and move on. Whole host of other considerations there, but that's kind of the general sense of it. And then it's, you have to, in some ways, trust that whoever stole your data or encrypted your data is going to be able to release it, if you pay the ransom. And so there are, even if you pay, there are some considerations to be made. But there are a lot of entities that will refuse to pay the ransom altogether, even if it's considerably more costly to get their data back another way.
Yeah. You kind of alluded to this, and if I'm going to probably mess up this summary, but when I remember when this industry was coming out, there was a talk, and again, my insurance background, which is limited, was in the auto insurance, but we had, catastrophes, right? Hurricane Katrina would happen, and we'd send CAT teams out there for the claims, and that would be a big loss. And but the exposure, at least in that world, typical property and casualty is proximate, right? Like, yes, there's natural disasters, but it's at least limited. With cyber, that's not the case, right? Because something like a solar winds or a catastrophe could actually be worldwide in terms of the severity and frequency of an event. Can you, and at the time, so I guess articles that I've read have said that's why cyber is slower to grow, even though it's hot, because the reinsurance market doesn't want to take on too much risk, and a catastrophe could essentially wipe out almost the economy. Is that accurate? And can you kind of talk a little bit about the difference when it comes to frequency and severity in the cyber world versus the more traditional insurance lines?
Yeah, I think you nailed it with the ag exposure in cyber is it's harder to get a handle on, and there are unknown potential sideways loss events, these supply chain events, supply chain attacks that could have dramatic impacts on a large scale in nature that you may not be able to subrogate against the original entity breached. And so that has been a concern for reinsurers. Ransomware, just the dramatic increase in ransomware severity over 2020 has led to, I guess, just from what I've personally seen, I would say that there's a tightening, among traditional reinsurers in the capacity that they're willing to put out on individual programs, as well as ceding commissions going down, because there's not necessarily the confidence of the high returns that they were probably achieving in cyber insurance over the last decade. Because you got to remember, when cyber started, the prices for cyber insurance were very high relative to the exposure, and then over the course of years, prices came down a little bit, and the policy language broadened out a little bit, and now I think in 2020 we've seen kind of the the pendulum is swinging the other direction, where now you have some pretty known and quantifiable exposures, particularly with the precipitous the increase in ransomware, and you still have that unknown risk. And so I would say the traditional reinsurance markets are in some cases tightening up, but then that is offset with we've seen a lot of new entrants, MGAs, managing general agents, in the marketplace. That there are plenty of stories out there on public record with certain MGAs hitting premium growth targets, and they are they are growth minded, growth focused, and they're going to hit that top line revenue number. But there's they have to be careful with that too, because on the other side, the premium that we charge as an industry needs to be commensurate with the exposure that we're taking on via the risk transfer. And if it's not, then these pricing practices are not sustainable. But we are seeing more entrants from MGAs. And then the other thing to maybe keep an eye on is the ILS market, the insurance linked security market, and will there be more products to facilitate risk transfer via kind of these non-traditional capital sources. And that's something that the property market has seen with cat bonds, catastrophic bonds, and financial instruments to really act as a risk transfer agent for insurance policies.
And are those something that kind of replaces, because reinsurance, I didn't explain it, but right, that's who insures the carriers, right? Or some carriers do it themselves, but in case of when losses get really bad in catastrophe situations, I'm probably oversimplifying it, correct me, but is that the ILS market, is that kind of doing the same thing? It's just from a different place?
Yeah. And there's also, so maybe to add another step, you have you have the company, they have their insurance provider. Their insurance provider may utilize reinsurance, and a reinsurer is just an insurer of the insurance company. So the reinsurer might take a sliver of the risk that the insurance company is taking on. Mm-hmm. And then you have to add another kind of layer on top of that, a retro reinsurance market, retrocession market. And so in that case, you can have a market that is willing to take some of the risk from the reinsurer, and that's where you get into some of these ag risk discussions, and that's kind of where I would see the potential ILS market coming in.
We're running a little bit long because this is pretty interesting. I apologize, I've gone a little off script here, but the last, I mean, just to kind of close this out, anything that you would say just in general about trends that you're seeing in the industry, or kind of what the outlook looks like for 2021 and beyond?
Yeah, I think in general, and just kind of put a bow on it, 2020 we saw big time increase in ransomware severity, little increase in ransomware frequency as well. So that is a key focus point going into the future that will probably result in rate increases for a number of companies, and may bring out further discussion with legislators and potential action taken outside the insurance industry to rein in that type of that exposure increase. I also think that it's going to bring in a lot more partnership with risk management companies to try to mitigate the loss before it happens. And then just general trend will probably be on pricing. And right now it's somewhat inconsistent. You do have these new entrants, a lot of the MGAs that are pricing aggressively, and they are kind of soaking up some of the some of the accounts that are put out to market because their existing carrier is driving some pretty substantial rate increases. So a lot of that will probably shake out in 2021 and in the next renewal cycle. But yeah, it's an interesting time to be a cyber underwriter.
Yeah. Well, thank you again, Nick, for joining us. This was very educational, and hope to have you back sometime.
Excellent. Thanks, Chris.